Chapter 4, Part 3, we're going to look at the cash flow statement, and in Part 3, we're going to look at the indirect method. So, when we do the statement of cash flow, we need to segregate cash activities between operations, investing, and financing. When we do operations, we have two formats. We can do the direct method, or in this example, the indirect method. I will do the direct method in Part 4. The only difference between the direct and indirect method is how cash flow from operations is determined. You still always get the same total. Of course, then we do investing, and then we do financing. Now, when you do the direct method, you're going to look at reports, and it looks at the cash effects of each operating activity. Under the indirect method, we're going to take our accrual net income and convert it to cash. So, let's go through an example using the indirect method, and remember that accounts receivable and allowance for doubtful can be netted. So what do we need in order to do a cash flow statement? First, we need 2 years on the balance sheet. We need the income statement for the current year, plus we need additional information that helps us analyze equipment, retained earnings, if there were any non-cash transactions, was anything bought or sold, and was there any write-offs. You need that information because you're going to use that when you analyze the account. Now, this is what I do, is the first thing I do is a look at the change in the balances. And what we're trying to do is explain that $19,000 increase. Where did it come from? Did it come from operations, investing, or financing activities? So, when we are done, our total for operations, investing, and financing needs to equal, in this example, $19,000 increase. And now, to do that, we're going to have to analyze all these changes. So, what we're going to do first, what I like to do, is once I've figured out the change, the next thing I'm going to do is identify where it would go on my cash flow statement using the indirect method. Well, accounts receivable, inventory, accumulated depreciation for building, and why do we include that? Because those are non-cash transactions that need to be backed out of net income. Accounts payable and income tax payable. Now we're going to look at investing activities. Of course, we have investments. We have no change for our equipment. Oh, and we have equipment that also would be investing activities, buying and selling long-term assets. And the last we do is financing activities. Now the land is non-cash because in the beginning it specifically told us that the land was purchased with stock. So we also have to remember to modify our our common stock to include that a portion of that is non-cash. $15,000 is non-cash, so only $35,000 of that change would be associated with issuing the stock. And then retained earnings, remember, is operations and financing because we've got net income in there and dividends. Now, the first thing I'm going to do is determine what our depreciation expense was. So I start with our beginning and ending balances. Then I have to take into account was anything sold. And in this example, a piece of equipment was sold and it was 60% depreciated, which means that they would have added back in taken that $6,000 out in addition to increasing it with depreciation expense. So now what we can do is we can work backwards to figure it out. So depreciation expense is going to be the beginning balance minus the $6,000 plus some number equals an ending balance of $21,000. So depreciation expense for equipment is going to be $13,000. Since there was no activity with building, we know the only thing that happened there was depreciation expense. So the difference there would have been $9,000. So now we have our total depreciation expense, which we need for our operating activities. So we're going to start with our net income. Add in depreciation expense. We always back out the gain because the gain is not cash. We add back in the loss. And remember, changes to current assets have an inverse relation to cash. An increase in accounts receivable is a decrease in cash because we had sales that people didn't pay us for. Now, changes in current liabilities go in the same direction because if our accounts payable goes up, causes an increase in cash. Because we have to add that change back in. I was just thinking about that. You have to add this because you've got expenses and income that haven't been paid for. So when accounts payable goes up, you have to allow for that. So we have our inventory, we have our accounts payable, and income taxes payable. So our net cash flow operating activities is $48,000, and this will be the same whether you use the indirect method, which I'm showing you right now, or the indirect method. Now, what I like to do is now that I have done operating, I like to cross these off because I know I've already used them. This one has no change. I don't care then. It's non-cash. I don't care. And then I'm going to subtract out all the operating activities because I've used that information. So now what we're going to do is go to investing activities. For investments, we started with 85. We sold an investment for $35,000, which would have reduced it. That's provided in the problem. We ended with 55. So cash used by investments would be 85,000 minus 35 minus the ending balance, which means that we purchased $5,000 for investments. Now, cash generated from investments, I always like to use the journal. That's the approach I use. So, I know that I had a gain of $15,000. It was provided. I know the investment was purchased at $35,000. So, therefore, the cash generated would be $50,000. Now, let's take a look at equipment because that's also part of investing activity. We had 48,000. We sold 10. We ended up with 70. So what happened? It means we purchased an additional $32,000 in equipment. And you always want to check that by saying 48 plus 32 minus 10 equals 70, which it does. Now, what about cash generated equipment? Again, I like using the journal entry. So, I had a loss on sale, which is provided. Accumulated depreciation was $6,000, which provided. I had equipment of $10,000, which provided. So the cash would have to be $1,000. And if you notice, if you add that up, remember, debits have to equal credits. So now we can do cash flow from investing activities. We have our purchases, we have our sales. Now we can cross those off because we've already taken care of those. And the next thing we're going to do is we're going to look at, we know that 50,000 of the top common stock, only 35 is going to be cash. So now we have to look at retained earnings. Okay, we started at 95, we ended at 92, we had net income of 67. Now we got to figure out how much did they pay out in dividends. And that would be 70,000. And again, check your numbers. 95 plus 67 minus 70 has to equal 92. So now we have cash flow from financing activities. We paid a long-term note, we paid out cash dividends, and we issued common stock, and we got cash of 35. Now we can do our cash flow statement. So, we have net cash flow operations, net cash flow investing, net cash flow financing, and it equals 19. We add dividend cash, we end up with what shows on the balance sheet at the end of the year. That concludes presentation of cash flow indirect method. Part 4 is going to be the direct method.